A very good morning, all of you students. Today we will be discussing on the topic of securitization. Let's start with our discussion. Today, on this topic, it's mostly on the conceptual side. So I will take you through some of the concepts that are there in our study material. And then I request all of you to go through the text of the study material so as to see if there's something is to be uh, asked or queries there. Okay. Good morning, Devraj. So yes, students, to understand securitization, I will try to make it, through some form of examples or through some form of case studies. Okay. So let us take an example, or let us take a case of Mr. A, who is actually trying to get a home loan. Okay. Good morning, Shailesh, Shruti, Viraj. So let's say Mr. A is in a need of housing loan and the amount that he needs is, let's say, rupees 1 lakhs. House loan or home loan, whatever we want to call it. Now, generally, students, home loan is for longer term, right? Let's say it is for 15 years, 20 years, 25 years, and there are EMIs attached to it. And the EMIs are dependent on the rates that are notified by the different banks. Correct? Now, Mr. A approaches a bank and it asks for the loan. What will bank do? Bank will do the verification of documents, right? Bank will do the verification of property. Bank will also verify the chain documents that are there. And then finally, it will tell Mr. A that basis your score, credit score, and basis your eligibility, you will be eligible for a loan of rupees 1 lakh, but at the rate of X and X%. So bank ultimately grants loan to Mr. A. Good morning, Mansha. So once bank grants loans to Mr. A, Mr. A enters into a contractual arrangement with the bank to repay interest as well as principal to the bank in a stipulated time manner. So Mr. A has committed to bank for repayment of principal plus regular payment of interest. So these amounts Mr. A will pay to the bank, right? And hence we call this as a EMI. So Mr. A will say that, okay, for every month I will pay 4,000 rupees as EMI for X number of years. Okay. And let us assume that this is for 25 years. Now, Mr. A has bought the house. Mr. A's, let's say, objective is fulfilled. Now, let's talk about the bank's side. If the bank has entered into this kind of an arrangement, right, and for 25 years, the bank's funds are committed, then what will bank do? In bank's balance sheet, for example, I'm just making a T format balance sheet, assets, equities, and liabilities. Okay. Now, this loan that bank has given to Mr. A, where will bank show in its balance sheet, students? On asset side or liability side? The loan that bank has given to Mr. A, is it asset of a bank or is it a liability of a bank? Yes, students. Please let me know whether this. loan given to Mr. A will be an asset or a liability? Yes, students, come on. Yes, Kusuma, Shailesh, Shruti, you are right. This is a these are going to be an asset. Okay. Because there is a receivable for the bank. Correct. So bank will show in its asset list what all things. Let's say housing loans, right? 1 lakhs. Correct. Now think from the bank's business standpoint. Yes, Namrata, Mansha, this will be assets. Perfect. Now think from the bank's side. Now if bank has to grow the business and bank has committed this 1 lakh for 25 years, 25 years minus whatever EMIs it will keep on receiving. Correct. Basis that principal amount, whatever EMIs it will keep on receiving, that will get reduced from the housing loan balance. But this amount is committed for 25 years. Now, the moment this amount is committed for 25 years, bank's earning capability is also limited. Correct. Because ultimately, bank will be earning on this 1 lakh. Let's say 8% is the interest. Only that annually bank will be able to bank will be able to realize. Now, what bank is thinking of is that let me do one thing okay, let me ask to all of you to expand the business of bank. Okay, let me tell you that equity was also contributed as 1 lakh. So this is the bank's balance sheet. So from equity of 1 lakh, the bank has given a loan of 1 lakh. Okay, practically this is not possible, but I'm just taking a hypothetical situation. Okay, now tell me one thing, if bank has to expand its operations, because primary purpose of bank is to lend the money so that it earns the higher interest. Correct. So if you are on the, let's say, board of management of bank, what do you think how you can expand? Yes, Mancha, that is correct. But my question now to all of you is that assume that you are in the bank's management and I have given you the situation that for whatever equity got invested, the housing loan is already given. Now, what do you think? How will you be able to expand or let's say grow the business of bank that is lending of money? How will you be able to do that, students? What are the possible options that you feel bank could adopt so that the interest income grows? Yes, student, we will make this session a bit interactive so that all of us knows. Kusuma is saying investing in some stock market. Okay. Shruti is saying invest the interest cumulative. Suraj is saying creating deposits. Okay. There are mixed answers. Let me take all of them. Anyone else has some other viewpoint? Okay, let's discuss on these three viewpoints that we have got. So Kusuma is saying investing in some stock market. So, but Kusuma, my concern that I've put forward is there are no funds. There is whatever you are seeing in the balance sheet, 1 lakh came as equity and 1 lakh got invested in the housing loan. There is no surplus funds to be invested in stock market. Suraj is saying creating deposits. So Suraj might be telling that we can get deposits from the public, right? So if let's say we can open different branches, right? And through those branches we can secure deposits. We can tell people to come and deposit their, amount as saving banks or current accounts for the businesses, right? So, and maybe for that matter, FDs or RDs, right? So tell me one thing, since this point has come, deposits, if I accept, which part of balance sheet it will be? Whether deposit is an asset for a bank or is it a liability for a bank? First, let's discuss on this deposits. This deposit would be an asset or a liability for a bank? Yes, students. Yes, Suraj, perfect. It's a liability. So, assuming we get the deposits, okay, but getting deposits, very nice. I can see a lot of answers. So, Suraj, Shailesh, Shruti, Kusuma, Mansha, all are saying liability. Basant Kumar is also saying liability. Ambika is also saying liability. Viraj. So, deposit, but when deposit is over, yes, Viraj, perfect. So, I think all of you are correct. Now, but I am again coming back to the expanding the operations of the bank. So deposits. So Suraj has suggested that bank can create deposits, and hence funds will be available with the bank, and it can further give a loan. But RBI has restricted. Okay, RBI has put some restrictions. Further, operationally, deposits will not count a very big sum. So I'm saying, let's say maximum to maximum 20,000 you will be able to get a deposit, because you can understand there are, although multiple retail, people who will be putting their deposits into the bank, but they don't account for that much. Okay, higher amounts. So, so I'm saying, okay, we got an idea. We will create deposits, but it will still limit the capability of bank, right? Because what will bank do? Bank will do another housing loan. But if you see, bank cannot do housing loan from this deposit money, because deposits money can be called out in a year, in 6 months, in 2 years, in 3 years, right? Housing loan, they will need at least 25 years to be given. So the life cycle of asset and the life cycle of liability has to match. That is called as ALM, asset liability matching concept, right? ALM, that we do in case of a bank. So we can create deposits and we can lend money and we can expand business, but again, here also it is limited capability, right? So I've taken this point that deposits can help in expanding, but in a limited manner. Shruti is saying invest the interest cumulative. Okay, that is also a smaller point, but still, Shruti, I think that also can be taken up by the bank. They will again get the interest and they will again invest it, but on that also they will earn some marginal income. Okay. Can anyone think bigger? Is there something else that we can do? Can bank borrow money? Yes, bank can also borrow money. But the moment bank borrows money, okay, and bank can borrow, let's say, 50,000, correct. But the moment bank borrows, the debt equity ratio, right? The solvency ratio, there are a lot of ratios that are there. The current asset divided by total, net worth ratio, or current liability divided by total net worth ratio also kicks in. So all these liabilities will will not help bank, because it will deteriorate their ratios position. Suraj is saying taking loan from RBI, it is as good as taking borrowing money, taking loan at less interest. So I'm not talking about, let's say, higher or lower interest. I'm talking about the availability of funds, first of all. Okay. Now, Can you think anything on the asset side, students? How can we expand our assets by doing some operations on the asset side? Is there a way, students? Just think it of. That is our real essence of this topic today. That's why I'm asking this. Deposit amount can be invested in the short term investment. Yes, Ambika, that's what I'm saying. This deposits, we will invest in short term, but not be helpful for giving a loan. So the bank's major income comes from the long term loans that they have given, right? Because that is where they do. SPV investment in this, no, Vancha. SPV is related, but how will, again, I'm saying that, how will that structure work? Okay, let me come to that. Okay, see, let me tell you. What will bank do? This was Mr. A. Bank has given loan of rupees 1 lakh. Mr. A has given commitment to bank repay the interest, sorry, repay the principal and interest. Okay, this is the commitment. Now, what will bank do? Bank will sell this loan, sell the loan to SPV, to let's say a special purpose vehicle, right? Special purpose vehicle means the one that is doing some specific activity. What is the specific activity? What is this SPV? We will come to that later. So as of now, just understand there is a new entity. Bank will sell the loan to them and SPV will pay bank rupees 1 lakh back. What will bank do? Bank has got that 1 lakh. Now bank will give another loan to Mr. B. Sorry, Mr. B, yes, rupees 1 lakh. Correct. Then again, Mr. B will give a commitment to bank for repayment of principal and interest. Bank will sell that commitment, okay, to SPV again. So you see, there is a good amount of funding that is available with the bank. What is loan, students? Loan is a commitment to repay principal plus interest payments. Perfect. So bank is actually selling this commitment to SPV. Sell the loan means selling the commitment to this SPV. So Shruti saying taking a security for housing loan. Yes, Shruti, that will be taken to make sure that the housing loan is secured. That is fine. Invest in financial instruments, but the problem was money was not there to invest. Then Kusuma is saying they can also issue some short-term loans. Yes, they can issue some short-term loans, but again, the funds are a problem. Where do we get the funds from, students? Good morning, Tanisha. Suraj is saying factoring. Okay. It is some form or the other of the factoring, but it is this concept is much larger than factoring. Okay. Now let's take this ahead. Okay, so this is understood. So bank will actually in its asset side, it will sell the housing loan, realize funds, and once those funds are realized, then it will use those funds again to give the fresh loans. Correct? Now, are there some questions unanswered in your mind? At this level, what are the other questions that are coming to your mind? How will SPV fund this purchase? From where the funds with the from where the funds to SPV are coming? That is point number one. Point number two, tomorrow, Mr. A and Mr. B will repay the principal and they will also be paying the interest. So whether it will go to bank or whether it will go to SPV, that is question number two. Okay. And similarly, there will be other discussion points also that we will do. Okay. Let's take ahead. Anything else till now, students? Now let me make a cleaner diagram. Yes, Suraj, SPV is a different entity. No, it's not form of a public fund, Ambika. It can be a private fund also. Shruti is saying SPV once again. Yes, I have not explained SPV till now. I will explain it now. Okay. So yes, we were here, right? So we said that bank is selling loans to SPV. Now what SPV will do, SPV will take that loan amount of rupees 1 lakh, right? And it will do the denominations of this. How it will denominate? It will say that, okay, I'm making 100 units at the rate of 1000 each. This got denominated. Then SPV will actually sell the denominations to whom? To, let's say, pension funds, HNIs, high net worth individuals, right? To, in fact, some of the mutual funds. So it will be sold to those people to which who have big amount of money with them, institutional investors. So it will go to them. Okay, students. So first of all, we need to understand that SPV, for whatever funds they need, they will create smaller denominations and they will sell those smaller denominations, let's say 100 units, and they will create a, let's say, a value per unit and sell those denominations. So what has happened in this process? while SPV has actually done the securitization of home loan. Correct? Don't you think SPV has done securitization of home loan? How? It has broken up the entire amount into securities. Those have been broken up, and those securities is actually sold to the people for raising the funds. Mancha, monetizing a bank guarantee, other alternative? No, Mancha, we cannot monetize a bank guarantee because bank guarantee can only be monetized once the conditions of bank guarantee is not fulfilled. Where that guarantee is revoked, then only the bank guarantee will be monetized. Anumula Sai is asking what is the difference between bill of exchange and securitization. We will come to that, Anumula. I will tell you. Mancha, this is regulated by. So we will come to that. Okay. Now, first of all, what this SPV has done, this SPV has actually created the securities and hence the process of securitization. Securitization is what? Converting illiquid assets to marketable securities. I hope this point is clear, right? Illiquid asset was what? This home loan. Marketable securities are what? The 100 units at the rate 1000 each are marketable securities. Okay, students. And hence, this process is called as securitization, wherein we are converting a illiquid asset. Why we call this as a liquid assets? Because this was for 25 years. And before 25 years, it cannot be liquidated. The cash flows cannot be realized. And hence, it is called as a illiquid assets. Okay. Now, coming back to this example. This is an illiquid asset that bank has given. Okay. Now, bank to SPV is actually selling of this asset. Now, let me introduce some bit of complexity in this, right? So, in practical life, what happens? It's not only Mr. A, Mr. B, Mrs. C, Miss D, and similarly XYZ till whatever are, let's say there are 1000 borrowers. Okay, there are 1000 borrowers. So, what will bank do for all these 1000 borrowers? They have the same borrowing product, which is the home loan. From now onwards, I will call home loan as mortgage loans. Why mortgage loan? Because in home loan, the property is kept on mortgage as security. Correct? The property is kept on mortgage as securities, and hence these are also called as mortgage loans because the entire home is kept as security. Bank will keep that home as a security for its lending purposes. So these are our mortgage loans. from, let's say, 1,000 pool of people, they have bank has created one mortgage loan stream, and that entire bunch is called as a bundle. See, students, I'm using those terms that are used in the study material. Okay. So all of you would be able to relate it once you are studying the text. So bank will bundle all these similar kind of mortgage loans. And after this bundling, bank will actually sell this bundle to SPV. Okay. Here bank is called as a originator because at bank's level, the origination of this transaction has happened. The origination of this bundle has happened. Okay. And this entire set will be called as bundle. This is called as originator. This SPV is actually SPV. So this will be floated. Okay. This will be floated either by the bank or by some other people also who are in the business of securitization. Okay. So we will come to SPV discussion later on. Okay. Then fourth are such people who are investors, in the SPV. Okay, students. So these terms that I have introduced are, I hope these are understood. Now, students, that above we said that bank is actually selling the loan to SPV. So in a way, what is bank doing? By loan, bank is having a right to receive interest and principal. Correct? Bank is having that right to receive the interest and principal. That right, bank is assigning to this SPV. This right, bank is assigning to SPV. So that SPV has a right to receive interest and principal, and later on, whatever cash flows these borrowers are giving, they will be received by the SPV. So this answers our second question, that SPV will receive the interest and principal on such transactions. Okay. Now again, I'm just creating a. So this discussion is clear. Please tell me, students, till now, are all of you there with me? Okay. Should we move ahead? Perfect. So now we said that illiquid assets have been converted to marketable securities. Okay. Perfect. This is the process that we have studied. Illiquid assets were what? Pool of assets. Can we say, let's say, now let's take a higher number, 10 crores. So here what has happened is 10 lakhs into 100. Okay. So this is also 10 crores. So they have done 10 lakhs worth each for 100 to arrive at the 10 crore number. And here, let's say for 10 crore, there are 1,000 borrowers. Okay. So in this, as per the previous analysis, or let's say as per the previous pattern, bank has run, or let's say the bank and SPV has run, bank and SPV has actually run their analysis saying that 20% of the borrowers will default. And this default will be not 100% default. This will be at the rate of 50% default. So only 50% amount will be received. Balance 50%, it will be defaulted by 20% of the borrowers. So can I say that 20% of 50% of 10 crore will go for a default, which is let's say 1 crore? Correct. Now, between bank and SPV, this fact is known. This fact between bank and SPV is known that out of this entire pool of 10 crore, 1 crore is going to be vanished because 1 crore equivalent amount will not come. And this has happened in the past. They have some reasonable basis to conclude that these 1 crore is not going to come back. Okay, wait, there are some questions. Shruti is asking, if loan is already sold, how will SPV receive interest and principal? Loan is sold to SPV only. Okay, so that's what I'm saying. We can actually think of, rather than saying that loan being sold, we can say that the right to receive interest and principal is assigned from the bank to SPV. Hence, SPV will receive the principal and interest, Shruti. Okay. Anumala is asking, can companies also do securitization? In your example, instead of bank, company. Yes, Anumala. Anything can go for securitization, but it has to be in a regulated manner. Okay. But for other things, Anumala, the market is not so much evolved. Only from the banking side, the market is evolved because banking side is where the majority of the funds are involved. Ambika is asking, mortgage properties will also be transferred to SPV. Yes. If the right to receive is transferred, the underlying property, or let's say the underlying security, will also be transferred to them. Now, Anumala, okay, perfect. So what I was telling is, now this fact is known to both bank and SPV. If they have an understanding between bank and SPV, then what will bank and SPV do? Bank and SPV have two options to enter into such kind of things. And I am using the word here, originator, and here is SPV. Okay. So there are two ways. One is recourse basis, non-recourse basis. I think most of you would have heard this terminology, recourse basis and non-recourse basis. I would want all of you to please respond on your understanding. I have given you a specific example where I am telling you that 1 crore out of the total pool of 10 crore can go default. So this fact is also known to bank and SPV. Now bank and SPV have two ways to enter into it. One is on recourse and second one is non-recourse. What is the meaning of recourse and what is the meaning of non-recourse? I think this all of you would have studied in your previous part. Okay, Shruti is saying yesterday only in FR class. Yesterday only recourse and non-recourse you have studied. Very nice. Then should I assume all of us are understanding it? Okay, let me explain. Mancha is saying recourse basis, bank will be responsible. Non-recourse basis means bank is not accountable. Yes. Suraj, recourse like in bills of exchange means it will come back to issuer. Yes, very good. So I think this itself is self-explanatory. Recourse means that SPV has a recourse to originator in case of a default. Would allow SPV to get funds from originator in case borrower defaults. In case of a non-recourse basis, no entitlement to the SPV to get funds back from originator. So, yes, Mohammed Abdul is saying in case borrower defaults, bank can held for recovery, that is recourse. Yes. Ambika, recourse means acquiring borrowers property. No, 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 Ambika. So recourse is between SPV and originator, first of all. Okay. Now, whether bank will acquire that property or bank will make that default good or bank will write off that NPA, whatever that bank do, that is a bank's issue. But bank between bank and SPV, bank will pay to SPV in case of recourse where SPV is not able to collect the amounts. Okay, perfect. So on a non-recourse basis means it is a dead loss to SPV. Okay. Okay, students. I hope our understanding is a bit evolved till now, right? Any other questions till now, students? I'm happy to take up. SPV will give 10 crore to bank and after 2 years, after running actual default, such default amount 1 crore bank will pay. Yes, Anumala, that is true. Now, let's take our discussion ahead. On non-recourse basis, if SPV is able to recover the amount. No, Mancha, in case of non-recourse basis, if SPV is not able to recover the amount, it is a dead loss. Sorry, it is a dead loss for that SPV. Okay. Now let's introduce more complexity to our basic diagram. I am just now putting here borrowers. I'm putting here originator. Okay. And I'm putting here SPV. Now, from the layman's term, we have moved to the technical terms. Okay. I hope now all of you are understanding what is the role of borrower originator. Now, this SPV has actually issued securities to investors also. Let us take that. This is issuance of security. This is actually granting of loan. And this is actually originator selling the loan. Now, what happens if you see the structure of this SPV? This SPV cannot function on its own. Okay. So this SPV will have to have some management. Okay. Now, what will be that management? If it is a company, then board of directors are there, right? If it is a partnership, partners are there. If it is a sole proprietorship, that proprietor is there. If it is a trust, who will be there? Answer this question. For a trust, who is actually called as the management of that trust? Tanisha, sir, it's like a bill of exchange which was endorsed to third party with no recourse or recourse basis, where the endorser would be liable in case of recourse and not otherwise. Please correct me. Yes, Tanisha, your understanding is 100% correct. But don't think that securitization is a bill of exchange. Okay. Securitization is a very bigger process than bill of exchange. Okay, let me take up that difference now. Okay, Tanisha, because this question actually came above also. So I will tell you the difference between bill of exchange and securitization right away. So let's take this first. See, we have bill of exchange and we have securitization. So first of all, bill of exchange is what? Bill of exchange is I am actually endorsing my receivable to someone else, right? And that someone else will again have a recourse and a non-recourse basis, but it is at a transaction to transaction level. Let's say I did one sale today and the credit period is 60 days to be received. I have endorsed that debtors that is standing today of that 60 days sale, and I've received the money on the 0th day. For 60 days, right? I am enjoying that money with me. Okay. However, securitization is actually a bigger concept wherein a pool of funds are assigned to a SPV, and SPV will have to raise money to accept that pool of funds, and that raising of money, that process is called securitization because it will do the securities. Securities, okay, what do you mean by securities? And can I ask in which act the securities is defined? Okay, tell me in which act securities is defined. What is that basic act where we have a definition of securities? And okay, tell me what do you mean by securities? Come on, students. In your CA final itself, you would have studied one act. Yes, very nice. I got that answer. Shruti is right. Suraj, you have mentioned it, but that act mentions some other act. The basic act in which securities is defined as Securities Contract Regulation Act. So here, if you see in bills of exchange, there is no process of securities. There is no process of dissecting the funds and involving and getting investors. Okay. So bills of exchange is a very small process. Securitization is a very big process because sometimes what happens, bank creates their own SPVs who are responsible for doing the securitization of the illiquid assets held by the bank, and they will operate as a SPV wherein they will invite the funds from investors. So Anumala is saying securities are units that can be traded. Yes, these are marketable units. Anumala is saying even in securitization, SPV will have to recover from each borrower, right? Like the transaction to the transaction. So I'll tell you, I'll come to that, Anumala. I was actually telling you how that process works in this. Okay. Instrument issued to raise fund. Yes. Securities Act, Securities Contract Regulation Act. Tanisha, just check once. Securities Contract Regulation Act. Okay. Instruments issued to raise fund. Yes, perfect. So now hear me out. I was actually asking this, who manages a trust? I think Tanisha has answered trustee, Shruti, Anumula, or and Mohammed Abdul has also answered trustee, Suraj. Yes, perfect. So trust is managed by a trustee. Okay. Trustee are those in whom we place trust. Okay. They receive our reliance of trust. Okay. So SPV will have some trustees appointed on the board who will make sure that the activities of SPVs are happening as desired. And these SPVs are mostly in the form of a trust. Okay. The legal form of these SPVs are mostly in the form of a trust. Okay. Now, what happens? Investors, while investing in these securities, they need a independent assessment from someone that the loans, the underlying mortgage loans are having a proper credit quality. See what has happened before it comes to SPV. Originator has already given the, let's say, amounts to borrowers by doing their own assessments, right? Because today, if someone applies for a home loan, originator will do 20 to 30 checks. 20 to 30, they have different checklists in which they will make sure that all those are complied with by the borrower before the amount is given, so that the risk is complied with. So those procedures have been performed here, but these investors are not sure whether those procedures hold good when the originator is selling those loans to SPVs, because tomorrow the biggest risk in this entire chain, borrower, originator, SPV, investor, is to whom? These investors. The biggest risk is these two investors, because these investors have invested the amount through securities in SPV, and SPV has given that amount as loan, and bank has used that loan to give it to the borrowers. Yes, very nice. I think Anumala has just referred what I was referring to here. So now what investors will ask? Investors will ask to do a credit rating of the pool of assets, whatever has been transferred to SPV, investors will say that, okay, what proof we have whether we will recover 10 crore also? We need a credit rating. So credit rating agencies come into play. And let me tell you, students, these credit rating agencies play a very, very, very big role. Okay. Don't think that they are only just rating the credit. They are actually the biggest decision influencers in terms of whether that portfolio is risky or not. I can tell you how this industry works because credit rating is not only on any pool of assets, is also on a company, is also on a specific type of security that is issued by the company, is also on this pool of funds. It is also on an economy like India, like any other country, like all the countries will have a credit rating. There are many credit rating agencies in the world who are doing this credit rating. You would have heard of about S&P, Standards and Poor's. You would have heard about Fitch rating, right? So, and likewise, there are lot of them. So, what are their what do they do? They actually go and again, they also have some 20-30 checkpoints. I'm just giving an example. They would be having thousands of them. But out of that 20-30, they know that if 15 are complied with, then this is a AAA rated. If some of them are complied with double A plus, triple B, like that. So they will categorize it, right? So highest credit rating agency, I'm assuming let's say it's AAA. Okay. In case AAA rating is there, then the risk is very minimal because credit rating agencies have concluded that the funds will be keep on coming and hence investors will actually be able to invest. But in that case, what will SPV do now? SPV will say that I will be giving you a lower return because your risk is lower because the credit has been rated very high, right? Okay, Shruti, who is originator and what is his job? Shruti, just check once. Originator, I have explained this is bank. I have replaced those previous terminologies with the revised terminologies, okay, which are there. So originator is a bank. Anumala is asking, are the securities created based on asset type or originator basis of particular bank asset? Will investor be disclosed this understanding between originator? Yes, Anumala. That is what they are actually, even not only they will be disclosing the underlyings, but they will be also getting that independently credit verified also, as I'm telling you. Okay. So they will know that. Could you explain, could you please tell that the term pool of assets in case of SPV used is the loan sold by the bank? Yes, Tanisha. That is correct. Pool of assets I'm referring to the loans that are that are given by originator to borrower and that are basically sold to the SPVs. Yes, Suraj, you are right. How can we verify the authenticity of credit rating agency through SEBI? No, SEBI don't have a role to play in credit rating. Okay. Credit rating agency's authenticity can only be checked by, let's say, if we are doing two, three different agencies. Okay. Every one of them have different, ways to do those things. Let's not go into that. But what I'm trying to say is that this is a very important step. If it is a credit rated, the investor's confidence also boosts up. Okay. Credit rated would increase the investors' confidence to invest in the SPV. Okay. If it is lowest, let's say double B, B, C, D, or whatever it is, then investor will not invest. But still, if there is some kind of an investor who is willing to take higher risk, highest risk, he or she will invest, but in that case, they will also demand higher returns. Okay, students. I hope the introduction of credit rating agency is clear. Yes, Tanisha. SPV is special purpose vehicle. See, generally SPV can be created for any purpose, any special purpose. Let's say today a very big project is coming wherein, let's say, an airport is coming in some of the city in India. For that airport to be coming, might be that Airports Authority of India Limited, along with some of the other companies, will create a SPV who will be responsible for the construction of that airport. So SPV can be for any special purpose. Here, the SPV's purpose is to purchase that loan and to do the securitization and collect the amounts, and doing the securitization process to do the credit rating as well, to get it credit rated as well, because then only investors will be comfortable to invest. Yes, Mancha, triple A is highest rated and hence less risky. Okay. I hope the discussion is clear till now. We will introduce more complexity. We will keep on introducing more complexity now. And then finally, we will arrive at what is the entire process. Okay. Credit rating may change over the period of time. Yes. Then risk also changes. In such case, how will the returns of securities will be changed for investors who have already bought such securities? See, in that case, they will either exit them. So Anumala has asked a very practical question. I really appreciate that. So what happens today? I invest and it was AAA rated. 2 years down the line, the credit rating agencies have actually downgraded that credit rating. What I will do, I will exit from that investment. If it is not in my purview, if it is not in my credit limits, I will, if it is not in my risk limits, I will exit that investment. Okay. So we generally see that FDI flows to India increases or FDI flows to India decreases. Similarly, FII flows to India increases or decreases. That happens because there is a separate rating of India that happens. Okay. So whenever it is improved, the inflows will improve. Whenever it actually deteriorates, the credit rating deteriorates for India, the foreign investors will pull back their money from India. Okay. And let me tell you, these credit ratings have a very big role to play. Credit ratings have a very big role to play in determining the interest rate or return percentages, basically. I'm getting the point. So, higher credit rating will mean lower interest rates. Okay, so there is a concession. If let's say the credit rating is triple A or double A plus or whatever it is, then let's say 0.5 percentage lower interest can be accepted by the investors. So they will accept a lower return because it is secured. Okay, perfect. Now let me again build that part. We have borrowers, we have originator. Now we have this SPV along with the trustees. We have these investors, and now in between investors and SPV, there is a credit rating agency also. Okay. Yes, Tanisha, that is correct. Okay. So what happens? This SPV will not sell the loan to investor. This SPV will create smaller marketable securities, which is called as securitization process. They will bifurcate this into n number of units, and then they will give it to the investors. Okay, through credit rating agencies after getting it rated. Okay, students. Now, what happens? Now let's come to the operational part. Some of the operational part. Okay. Now this borrower and originator and SPV. Okay, we are here. Now what originator will do? See, okay. This is a mortgage loan, and for originator, transfer of loan that will happen. Correct? And these trustees are actually responsible for the overall oversight decision making of this SPV, which is formed as a trust. And investors will invest in securities, right? Now, what will happen to the borrowers who will be paying such interest and principal? Now, borrowers, will they pay it to the originator, or will they pay it to the SPV, or will they pay it to some other party? So, generally, what we have seen here is there is a another party which is called as receiving and paying agent. Actually, this is appointed by originator to help get all the fundings, to get all the cash flows of repayment of principal plus interest payments. Repayment of principal plus interest payments, that borrower will be routing it through a receiving and paying agent whose responsibility will be to maintain the entire ledger of, let's say, loan book, to make sure that the servicing is happening. By servicing means the interest service is happening, the debt service is also happening, and finally, it will actually transfer that amount as per the arrangement to SPV. Got my point, students? Yes, then they will pay to SPV. And what SPV will do? SPV will actually do that return percentage to investors. So in this entire chart, I have introduced a new agent, which is a receiving and paying agent, whose responsibility is to actually uh, come up with the entire management of the book of loan, to make sure it is receiving and it is paying, and it will maintain all the records so that there is no default later on, at least from the bookkeeping or the recording or the collections point of view. Okay. I hope this is clear, students. Now, I have a question for all of you. What do we mean by mortgage-backed securities? So, students, it is very easy to link up the discussion that we did. Okay. The answer is in this table only. I just need to understand whether all of you can actually relate that. Okay, so hence I'm just opening it up. Although I've not explained till now what is a mortgage-backed securities, but I just want an attempt from all of you to let me know what do you mean by mortgage-backed securities. No, Anumala, we are not saying the full value of pool of assets are paid to originator. What is the benefit to SPV? How will it give returns to investors? Return only interest portion of such loan. No, Anumala, I am not able to understand your question clearly. See, what I'm trying to say, Anumala, here is that originator will receive the entire loan amount on 0 day when it transfers the loan to SPV. Now, whatever later on for next 25 years, the interest as well as principal will be keep on coming. That will keep on going to the SPV, and then SPV will keep it with them. What SPV will do? SPV will actually distribute it back to the investors in the form of a return. Okay. So Manoj is saying mortgage loan. Okay. Tanisha is saying, could you please once state the role of receiving and paying agent? Okay. See, the role of receiving and paying agent is to make sure that the all the collections related activities are happening. Because see, the moment originator has transferred that loan to SPV, originator will say that I have received the money, and SPV will also not have a trust on originator now, because whether originator will actually, follow up for that recoveries, or get that proper records for how much we have received from whom will be an issue. So what originator and SPV will collectively do is they will appoint a specific agent who is responsible for carrying out the activity of receiving and paying it back to the SPV, whatever cash flows are there. Because see, someone has to keep a record of, right, what dates, what amounts are due, and hence those needs to be collected. In case of a non-collection, because generally what happens, there are post-dated checks that are given to the banks. So banks, what they will do, if EMIs are not cut, they will put the post-dated check. So all those administrative tasks are there. Okay, students. So receiving and paying agent have a very broad role to play. Sorry. So Manoj is saying, I had asked about this question, mortgage-backed securities. Manoj is saying mortgage loan. Okay, but mortgage loan is something else. It is somewhere related to mortgage loans only. Security supported by SM immovable property. Yes, Suraj, somewhere you are correct. Mohammad Abdul is saying securities which are issued by SPV, which has home loans as underlying assets. Yes, very good. This is the complete answer. So Mohammad Abdul, you are right. Tanisha is saying ordinance is the function of depository in case of a stock market transaction. Yes, Tanisha, something like that you can say. But depository will only hold the dematerialized shares or investments. Here, they are also doing transactions for receiving and paying. Okay. So just make a note of it. Now, yes, I think Abdul has correctly stated. So, students, if you see the securities, okay, I'm actually referring to these 1,000 securities that SPV has issued to the investors at the rate 10 lakhs each, right? That is what we have discussed. So this 1,000 securities at the rate 10 lakhs each that SPV has issued to the investors will be backed up by these mortgage loans, correct? Because ultimately originator has given the mortgage loans to SPVs and SPVs has created securities out of it. So there is a backing up of these entire mortgage loans. Hence, these are called as mortgage backed securities. These securities are called as mortgage backed securities because they have an underlying of the mortgage loan. Okay. They have a underlying of mortgage loan and hence these are called as mortgage backed securities. The entire US recession students in 2008, I don't know whether all of you would have heard news at that point of time or not, was because of this mortgage backed securities. Because what has happened is they have done entire securitization wherein lot of credit rating agencies have rated these credit rating agencies have rated uh, very high risky, mortgage loans also as a good quality credit, with because of which the investors kept on investing. And ultimately the house value is the same, right? Because what was happening for a house value of 1 lakh, they were actually giving a loan of 120, 1 lakh 30, 1 lakh 40 like that, and people were keep on buying and purchasing the same house which actually had a price of 1 lakh at a higher value. And the credit rating agency also kept on giving the higher credit rating, which kept investors also investing. So one day the bubble burst up. So the real value of that, when the bank had gone and recover that loan from that selling that asset, was only 1 lakh. However, the loan standing in the books of originator or SPV for that matter was 1 lakh 50,000. So everyone suffered a loss in that case. Okay. Anumala, so original rate of interest charged to borrowers and investors rate of might be equal or less than such rate. Yes. Devraj, I didn't understood your query, Devraj. Then Tanisha is saying issue back of the mortgage loan asset in the form of small chunks of securities from the SPVs to investors. Yes. That means borrower taking loan from bank and buy the same securities from SPV. Borrower taking loan from bank and buy the same securities from SPV. Yes, Anumala, for 2008 recession that had happened. Because what was happening, this borrower will invest here also. Okay. Issue back of mortgage loan asset in the form of small sums of securities from SPV. Yes, that is true. So, Tanisha, that understanding is correct. So, students, that is how the mortgage backed securities and the basic process of securitization works. Okay. So I hope our understanding a bit evolved with this discussion of uh, today's, right? So we will continue our discussion. Let's break for 10 minutes. It's 8:18. Let's again reconvene at 8:28. Thank you. Yeah. So, before our break, we have discussed the basics of securitization, right? And in terms of coverage, I think more or less we have covered the entire process, how it brings out to securitization on paper. Okay. So let me just have a quick recap so that we will move to our other, parts of the session today. So we said that a bank is an originator which would have been given earlier a mortgage loan to a borrower, and bank will actually take those mortgage loans and bundle them and transfer them to a SPV, which will have some trustees formed, and that SPV will actually create some securities out of those loans, and they will issue those securities to the investors. The receiving and paying agent was also appointed by the originator and SPV collectively to make sure that the collections are coming, as well as the proper admin related stuff is also happening. Even one credit rating agency was also needed to certify or to rate the overall credit for the mortgage backed securities. So Tanisha is saying we have to give a formal definition. So mortgage backed securities are such securities which have underlying as mortgage loans. Okay. Okay, students. So I request all of you to please go through the contents of the study material. We will discuss some other topics or some other portions from the study material now. So structure, we discussed that the borrower, there is an finally we discussed that in terms of structure, there is a borrower, right? Let me just add. Yes, in terms of structure, we discussed there is a borrower, then there is an originator, SPV and investors, correct? And this borrower would have, let's say, borrowed for 25 years, 7% per annum per interest. I'm just giving that an example. And let's say they will have a 40,000 of EMI kind of a number. So all these things are actually structured. Now, with this actually, see, let's say the borrower has borrowed a sum of amount for 25 years, 40,000 will be an EMI. So for credit rating agency to do the credit rating of the entire pool of funds, they will also check the house or let's say the property underlying, right? So they will also issue a credit report on all these parameters, then they will sum up that credit report on an overall level. But in that, we have actually already discussed, but I'm just putting it down again. So if the risk is lower as per the credit rating agency, the returns to the investors, we are talking about those investors who have invested in the SPVs, will also be lower. If the risk is higher, the return to investor will also be higher. And how it gets rolled up. Now, in our case, we had pool of assets, correct? For these pool of assets, what was the pool of assets? These were the portfolio of loans A, B, C, right? For all of them, there was a different risk and return profile. Again, I'm going to our portfolio management days. Okay. basis that there is a overall risk and return profile of this portfolio of loans. Correct me if I'm wrong. Correct. And basis that this risk and return profile, whatever credit rating agencies does, these securities that have been generated will be rated. Correct. I hope this process is clear. Okay. And finally, these securities will also have a risk and return. I'm talking about these securities also. And the underlying for that risk and return will be the portfolio of loans risk and return. And the portfolio of returns underlying will be A, B, and C, or whatever these were. Actually, I've also used here A, B, and C. So let me use here, let's say, security, anything. Let's say Z, security Z. Okay. I hope this is clear. Now, we can also understand it from this angle that who will keep how much, right? So let's say borrower is giving to originator 10% of interest. Now SPV to originator, let's say it is at 9%, 1% originator will keep. That's the arrangement, right? Then SPV will have to pay 9%, but it will pay to the investors only 8%, because in 1% it will take it out all its expenses, right? Whatever are the local expenses that they will take it out. So ultimately, investor and borrower, if you see, borrower ends up paying 10%, but investor ends up earning 8% because 1% is retained by originator and 1% by SPV. Getting my point? So that they are able to meet out their different expenses that they are doing. Now, let's come to different types of securities under securitization. Please hear this out very carefully, students. Okay. So we are coming now to securitization instruments. Okay. Now let's restrict our conversation to SPV and the investors to whom such securities are issued. Issuing securities sorry, issuing securities to the investor. Sorry. Correct. SPV will be issuing securities to the investors. Now, here we are talking about three different types of securities. Pass-through certificates, pay-through securities, and lastly, stripped securities. Okay. There was one question from, I think, Anumala, where he was asking, Anumala Sai, where you were asking that if full value of pool of assets are to be paid towards the benefit to SPV. Yes. So this benefit to SPV, that question I answered here, okay? When I said that 1% will be retained by SPV. Further, there was one more question on this how this collections will happen, which is through this receiving and paying agent. Okay, students. So that is also there. Now, as I mentioned that there are three different kinds of securities that are there. Okay. What are they? They are pass-through certificates, pay-through securities, and stripped securities. So students, pass-through certificates, we will discuss them in detail. But pass-through certificates, as the name suggests, that it is some kind of a pass-through. So in your practical life, you would be hearing, let's say, some kind of a pass-through SPV. Pass-through SPV means that, or pass-through, something that where pass-through is mentioned is, it is passing through. Whatever has come has gone, right? Whatever has come has gone. For example, mutual funds are also one kind of pass-through investments, because what you are doing is you are collecting the pool of funds, you're investing, whatever return is coming, you're passing it through, right? In the same manner, in the same color. Pay through securities means that you are paying, but it is a different obligation altogether. It is not dependent on what you are receiving. Okay, I will explain it in detail. Yes, Anumal, they can be same also, but generally they will not be same because again, today is a world of specialization. So SPV will only specialize in managing this portfolio, right? And discovering more and more investors, and they will market their securities better. However, receiving and paying agent, which will involve a very transactional work, which will be a separate one. Now, students, first of all, tell me, I'm putting here some examples. You tell me what is the underlying. Whenever we talk about a equity, can you tell me for an equity, what is an underlying? Debt, derivatives we have not covered till now, but still I will touch upon, I mean, we will be covering now, but derivatives also, and then mortgage backed securities. So mortgage backed securities underlying we just now discussed. This is the mortgage loan itself. Correct? Now tell me one thing. What is the underlying for equity, students? What and through how equity derives its values? Can you think and tell? What is exactly an underlying for an equity? How will equity derive its value, students? This is very important to understand. So Anumula is saying capital appreciation, Ambika is saying market index, Suraj is saying profits, Kusuma is saying capital fund, Tanisha is saying profitability and assets of business. Yes. Somewhere I think all of you are very close. All of you are really very close. So the underlying for equity is the business. Simple. If your business flourishes, the equity will also be higher. And hence your capital appreciation, market index, profits, assets, profitability, everything will be higher. Right? So the fundamental underlying for an equity is business. So Debt will be what? Debt is actually the fixed, because debt will need the fixed coverage, right? So I can say stable business, some kind of a stable business that, minimum this much we are generating, so that there is a cash flow generation that is happening. Through that, we can serve our debt. Derivatives we will discuss in next session. Okay. I'm holding it for next session. There is a detailed discussion that we will do in next session. So what I'm trying to relate it for a MBS, which is a mortgage loan, and similarly for an equity, which is a business, which for which the underlying is business, the cash flows will actually depend how business is performing. Similarly, for pass-through certificates, there is a simple correlation between what fund is receiving and what they are paying. Let me explain through three cases. Okay. This is borrower, this is SPV, and this is investor. Okay. So what this borrower is doing, this borrower is actually, let's say, paying its obligation on time. 100 rupees they have paid for principal, 50 rupees for interest, and 150 they have actually prepaid. So they have done the prepayment of 150. They can do, yes, they can do. Home loans allowed prepayments. Okay. So borrowers have paid in totality 300 rupees to SPV. I'm talking about the cash flow. So this prepayment was not part of the contractual cash flows from borrowers, right? But borrower said that, okay, I have to pay you. I got some higher cash flows. So I'm prepaying you by 150. Now, what will this SPV will do to the investors? SPV will distribute entire 300 rupees proportionately, because SPV has already, distributed units to investors. So within those 1,000 units or whatever, 100 units, 1,000 units, whatever those units have been issued by the SPVs to the investors, it will actually distribute this entire 300 rupees to them. So this 300 rupees will be distributed to them. Second case I'm taking, because this is a pass-through certificate, right? Hence, whatever came in, got out. SPV might have retained something for running out its, operational expenses. Yes, Tanisha, you were right. Okay, we will discuss these things in detail in our next session although. Perfect. So I was telling you pass-through certificates. The second case I'm taking, borrower, SPV, investor. Now borrower pays only 100 rupees of principal plus 50 rupees of interest. Only 150 rupees. Now SPV will also pay rupees 150 proportion proportionately to all the investors. Simple. 150 came in, 150 gone out, and SPV will again, let's say, retain 2, 3, 4, 5%, whatever they have agreed for their operational expenses. Simple. So investors are actually exposed to the returns or to the cash flows that borrowers are paying to SPVs. Correct? They don't have a separate secured cash flows with them. I hope this is clear. Third case, borrower, SPV, and investor again. Now here, borrower has to pay 80 rupees, but borrower has defaulted on this payment. Sorry. So the borrower has defaulted on this 80 rupees payment and hence no payment to investors. Although contractually the borrower was supposed to pay to SPV 80 rupees as per the EMI plan or as per the contractual repayment plan. But now there is no payment happening to investor. So it is exactly passed through. In the first case, the pass through has happened for 300 rupees. Even something got prepaid, that also has to pass through investor. In a second case, exactly whatever was the contractual cash flows, 150, got passed through to investor. Third case, borrower has defaulted. Even that default has also passed through to investor. Okay, we are not talking about the recourse or non-recourse here. That is a separate discussion that is between SPV and bank, which is originator. So we are talking about here the relationship between SPV and investor and the kind of security that they are holding. So Tanisha is asking here, why will 150 will be prepaid by the borrower? Tanisha, because what happens practically, the borrower might get some extra cash flow after, let's say the loan tenure was 25 years, but the borrower has got an extra cash flow after the end of fifth year. Now borrower wants to reduce the loan amount because borrower does not want to give higher interest on the higher amount, because borrower will not be able to earn that much of interest on that amount which he or she is paying on the home loan, because the payment of interest is higher than the return that he might get on that amount. So he or she would want to prepay the amount so that future interest payments are reduced. Okay. Anumala is asking, investors will get the returns only when after recovery of loans, or will there be any maturity date for these securities? No, Anumala. As I said, whenever the cash flow will come to SPV, it will get distributed. So there is no commitment from SPV to investor. There is no commitment from SPV to investor. The only commitment from SPV to investor is that whenever SPV will receive the funds from borrower, it will pass it on to the investors. In the first case, why interest is not taken in pass through? We have taken in pass through 100 plus 50 plus 150. That total is 300. So 300 itself we have taken for the pass through from SPV to investor. Okay, students. Okay, I hope this is clear. Yes, these securities once created will go on. Okay. Now come to pay through securities. Now for pay through securities, what do we have? Now here, let's take in same examples and then I'll tell you the difference. So students, pay through securities are So students, pay through securities, what will happen? 100 principal, 50 interest, 150 prepayment. Total how much we have got? 300, right? However, SPV will have a commitment with the investor to pay only 200. So what SPV has done before issuing these securities to the investor, they have told that we will only pay you 200 rupees per month, per annum, or whatever is the frequency that they decide. Okay, let's take an example per month. So this 200 rupees will be paid minus 200, balance 100 will be invested by SPV. Okay. So can you see the change here? It's not passing through. There is no pass through of the entire 300. So only that amount which is committed to the investor is being given to the investor. I hope this is clear. Now let's take a case 2 in this. No, Tanisha, 150 will not have a penalty interest. In today's world, banks say that banks are coming up with a product wherein they will say that, okay, if you want to repay, you start repaying after 1 year. Only for 1 year there is a lock-in. After that, whatever you want to repay, you repay. So these days, banks are not charging any interest on the prepayment. Investor is taking the highest risk. Yes, Mancha, investor is taking the highest risk. Anumala is saying securities will continue being traded in the market. Yes, securities will continue to be traded in the market. Manjunath is asking who is going to pay expenses of collecting agencies. Manjunath, so that's what I have actually tried to explain through this 1% and 1% retention that is happening. From there, the expenses of receiving and paying agent will be taken out. Because borrower ultimately is paying 10% in the entire chain, if you see, but investor is only receiving 8%. So that 2% in between all the intermediaries will earn. Okay. Yes, Anumala, you're right. Okay. Then this is first case. Second case. Second case will be wherein the pay through securities, there is a borrower, there is a SPV, and there is a investor. Here, that original cash is paid of 150. Now this SPV to investor will be 200 because this is not going to change, right? Because these are committed cash flows. That's what I'm trying to mention. Committed cash flows. Because these are committed cash flows, whatever in background is happening from borrower and SPV has to pay 200. So 150 is received by SPV minus 200 is paid by SPV. There is a net shortage of 50. So this will be funded from this investment. Okay, the earlier investment they have done. Funded from case 1 investment. So Mohammed Abdul is asking where will be the SPV investing excess amount? It can invest anywhere. That will also depend on the rules. That will also depend on the trustees' decisions and that how that entity is formed, right? Whatever is, let's say, for example, in a company's articles and MOAs, it is defined, right? And similarly, Companies Act also it is defined what all places it is prohibited. So similarly for SPVs also there will be some governing mechanism wherein they will park those excess funds for the time being. So this borrower SPV investor case number 2 is clear. Let's come to case number 3. Okay. Then, then what will happen in the third case? Borrower defaults. Correct. Again, I'm taking that rupees 80 is not coming to SPV now. Now, SPV will have to pay 200. Correct. So the income of SPV is 0 this time, minus 200. So minus 200. Out of that minus 200, wait. Out of that 250 and 150. 50 will come from previous investments. And another 150 they will have to borrow and pay. Because it's not a pay through, it is not a pass through certificates, it is a pay through securities. The moment it is pay through securities, they will have to resort to the fixed cash flows that are needed to be paid. Okay, yeah, Mancha, as per SEBI regulations, they can part investments. Yes, they can do investments also, and they can borrow also in case they are paying through securities. If they are pass through certificates, then there is no issue. Sorry. Okay. So I think this discussion is clear. So can we summarize? Pass through certificates, which we also call as PTC. Okay. We say that cash flows of the investors would be linked directly to the cash flows of the mortgage held by SPV. After recovery of entire loan amount, will the SPV continue dissolved, or another pool of assets are transformed in case of will another securities are created? Same securities. No, 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 no. Anula, yes. See, once let's say the first set is completed, it might happen that there is a business for that SPV. They will continue with the other set of loans. But for that, another set of securities will be formed. Okay. So there is another securitization process for that will happen. Okay. Perfect. So that's what we have mentioned in a case of pass-through certificate. Cash flows of the investors would be linked directly to the cash flows of the mortgage held by the SPVs. Okay. Whatever mortgage loans that they are holding by the SPVs, they will be directly linked to the cash flows that the investors will be getting. Um, Pay through certificates. Sorry, pay through securities. My bad. Which is also called as PTS. So this is actually a independent relationship between SPV and investors. This is independent to what uh, this is independent to what borrowers have to SPV. Okay. Cash flows of the investor is not linked directly to the cash flows of mortgage loan held by SPV. So there is a delinkage, right? Both the things are delinked. Pay through securities is delinked to the cash flows that they are getting from the mortgage loans. Okay. So here we are saying that the surplus can be invested by SPV or deficit can be borrowed by SPV. So Tanisha, it depends actually. It can be through a pass-through certificate. I mean, some of the investors can prefer a pass-through certificate or pay through securities. We have called out what the concept is, right? Now it depends how that fund also want to structure it, right? Sometimes they would want, no, no, we will have a pay through securities. We want to delink the cash flows between both, right? So I mean, there is no thumb rule to say that okay, they will prefer this over this, right? So it will be very context specific, situation specific that we need to understand. And lastly, I can say that investor and SPV would agree to a payment plan which is going to be independent of mortgage cash flows. Okay. At last, I can say that for PTS, there is a desynchronization between cash flows to be paid to investors and cash flows to be received from assets. There is a complete desynchronization, students, wherein the cash flow to be paid to the investors is totally different than the cash flows received from the assets. Okay. Will SPV create only PTC or PTS for a set of pool of assets, or they'll create both? No, they will only create one only, right? Otherwise, it will be difficult for them to manage. Mansha, there is no stable return in PTC, whereas PTS investor is better. Yes, I am coming to that point now, Mansha. Tanisha, certain like is PTS, it carries a fixed obligation similar to debt requirement, like the PTC, which has no fixed charge of but flexible pay. Yes, your understanding is correct, Tanisha. Tell why there is any other point. Tell, is there any other point in case of PTC? If any, no. That's all. Now, see from an investor standpoint, okay. So this PTC, PTS, right? This is pass through, right? So one prepayment would also be for investors. The moment prepayment happens, it will also be for investors. Prepayment would not impact return for investors, correct? So we can say that there is no stability in return, correct? Here we can say that there is a stable return or stable cash flows. Here there are spikes. Okay, students, I hope this is understood and clear from PTC and PTS. With this, we conclude our discussion on PTC and PTS. Now we will do our discussion on stripped securities. Okay. Let me know in case anything is unanswered or anything more needs to be discussed. But I think we have discussed in detail the entire process of securitization, correct? And also the different kinds of securities that are available through PTC and PTS, right? Then let's now discuss on stripped securities. Yes, students. So stripped securities. See, so let's talk about a total amount of 150, okay, wherein we are saying that the interest is 50 and principal is 100. Okay. What we will do in stripped securities, or what SPV will do on a stripped securities, they will strip. Strip out means separating out, right? Separating out means basically we are creating different streams of cash flows. So they will strip this entire cash flow into two parts, right? One is IO and another one is PO. This is interest only. This is principal only. What do we mean by interest only and principal only? So they have created two different type of securities. One is called as interest only security. Second one is called as principal only security. The interest only security will be carrying the cash flows related to interest. The principal only security will be carrying only cash flows related to principal. So what is SPV going to do? So SPV is going to market slash sell IO and PO separately. Wherein we will say that SPV will have one IO and one PO. There will be a separate investor for that, interest only, and for PO there will be separate investor for this. So let's say they invest 1,000 rupees here. Let's say the investment will be 500 rupees. This is the amount and all, right? Now let's also talk about how these movements will happen in case of IO and PO whenever YTM changes, yield to maturity changes. So students, we know that market rate is actually coming through a yield curve, right? Market interest, yield to maturity, correct? That actually is coming because of the market forces, right? And it keeps on changing. That all of us would have studied in our previous sessions on the bond valuation, right? So in case YTM or the market interest rate goes up, okay, initially it was 10%. Day zero, it was 10%, right? When we entered in this arrangement and we stripped it out, then it will be 12%. Sorry, Tanisha, what is spikes? Could you please tell? Spikes. Sorry, I think because of spikes means sudden increase. This is K, spikes. Okay. Spikes is sudden increase in the return and all. Now, so day zero, it was 10%. Now it has increased to 12%. Then what will happen now? Since the price has gone up, sorry, the interest rate has gone up. Okay. So we are trying to say that what will be the impact in the value of these securities for IO and PO? Earlier, the security was for 50. Do you think if the market interest rate has gone up, the IO value will increase or decrease? Tell me, friends. If the interest rate has gone up from 10% to 12%, so the value of IO securities will increase or decrease. Similarly, then we will come to PO also, principal only also. So the value of IO will actually increase and the value of PO will decrease. Why value of IO will increase? Because now earlier we had 10 percentage. Now we will be getting 12 percentage. Okay. So it will become, let's say, 60. Principal only we know that the price of bond is inversely relation to interest rate. So principal only is actually the price or the principal itself or the price of the bond itself. So it will have a negative correlation. So it will come down to 83. It will reduce. Tanisha is saying increase. Mohammed Abdul is saying decrease. Mancha is saying direct relation. Okay. So I think I have explained what do we exactly do in case of an increase. In case it goes down to 8%, so the interest only value will also be going down to equivalent 8%. Reason being, earlier the interest was being calculated as 10%. Now the revised percentage, because it has gone down, will be 8%. Similarly, here it will be increasing. Sorry. Okay. So Anumala is making a good point. I think it will be same because the rate of interest is already agreed between the borrower bank. That is true. But these securities are separately traded in the market. Okay, so these securities are separately traded in the market. Hence, we are talking about that valuation. So this 50 rupees is going to be remaining constant. We are not saying that 50 rupees will change in terms of the cash flow, but the value of that 50 rupees is not 50 rupees. The value of that 50 rupees now is 60 because the interest rate has gone up from 10 to 12. Okay. Now let's take an example. We are taking an example of pass-through certificates. And I'm trying to tell you how pricing happens. Okay. Pricing means how the consideration is getting fixed. So let's take an example. There is a principal, interest, and maturity. Mortgage 1, mortgage 2, mortgage 3. Okay. Mortgage 1 is having a principal of 100 crores. 5% is the interest and 2 years is the maturity. Second one, 200 crores. 5.5 is the percentage and 1 year is the maturity. And lastly, 200 crore, 6% and 1 year. In totality, this has been assigned to an SPV. Okay, students? Okay, so in totality, this has been assigned to an SPV. Now, SPV will raise 500 crore, correct? So they will do the denominations into number of units to be equal to 500 crores. Okay, now there will be two things that will be calculated. Weighted average mortgage rate, which is easy to calculate, right? 100, we will take the respective weights. and multiply it with the interest rates, like we have been doing in our portfolio management, right? We take the weights and we multiply with the return percentages. So we will end up having, which was 5.6%, right? So the average mortgage rate to be recovered while this will be assigned to the SPV is 5.6 percentage. Now, from this, we will reduce the operational cost, which let's say is given 0.6 percentage. So net pass through percentage becomes 5 percentage. So this is how the pricing is determined for that security, students. I hope this is clear. Even then, if the rate increases, still the investor will get a return of 10% only, right? Sorry, Anula. Yeah. So what I'm saying, Anula, is that yes, they will still the cash flow. Sorry, the cash flow from borrower to SPV will be 50 rupees only, but the real value of that security being traded in the market will be 60. Okay. See, just understand it from the same point of view that in your bond valuation, you would have studied that the interest rate never changes. The interest payout never changes. It is on the face value of the same percentage that has been agreed by the issuer. But the yield changes. That is the pricing of that security changes because of that. Whenever you enter or exit after it is issued, it will change your yield. Okay. Okay. So this is net pass through. Okay. Yes, Tanisha, you're right. I hope the pricing is clear, students. Correct. So whatever overall number that the SPV is getting, from that they will retain some amount for their operational cost. Net amount they will include for their pass through. Similarly, they will also calculate weighted average maturity, because it is also very much important to understand that when the maturity is going to come. Again, we can use the same logic: 100 divided by 500 into 2 years, plus 200 divided by 500 into 1 year, plus 200 divided by 500 into 1 year. So this is 0.4 years plus 0.4 years plus 0.4 years. So this becomes 1.2 years. So net shell 1.2 years, they will have the weighted average maturity. So SPV would propose to investor a return of 5% with a with an average maturity of 1.2 years. Okay. Okay, students. Okay, perfect. Then I think with this, we close our discussion on the securitization mainly. Okay. Then now let's go to the blockchain. Okay. Any questions till now, students? Happy to take it up. Otherwise, we'll move to our next and last topic, blockchain and tokenization. Okay. Since this being also part of our study material, so we have picked up this topic under this, securitization concept. And there is a relatability between securitization and tokenization. Okay. So I should mention and here. Okay. Because these are two different concepts, blockchain and tokenization. So should we move ahead, students? Please do let me know once, or if there's something else to be discussed. With this, at least I can tell you that if you go through the text that is mentioned in the study material, you will be able to understand these all terminologies, these all, you know, the benefits, or let's say the features of the entire uh, securitization. Okay, students, should we move ahead? Perfect. Good to go. Good to go. Perfect. Thank you. So, students, now please hear me out. This is a totally different, topic. Then we will see how tokenization, how blockchain is related to tokenization, and how tokenization is actually related to securitization. Okay, so blockchain, students, first of all, this is a very new thing, right? Not new now. I mean, this is dated back to 1990s when this technology came, but this was actually implemented in 2009 for the first time. Okay. So what does this technology says, or what does this, entire ecosystem of blockchain, how it works is, um, what was happening earlier is that I'm just taking first the example of financial transactions. Then we will also go through some of the non-financial transactions where blockchain is used. Okay. Now today, if we have to make a certain payment, okay, let's say from India to US. Okay. So this is some payment that we have to make. The moment you have to do it, you will have to involve intermediary banks. So there will be an Indian bank, there will be an US bank. Okay, let me do one thing. Let me take an example of not US. Let me take an example of any other country. Let's take Australia. Okay. So there will be an intermediary bank in India. There will be an intermediary bank of Australia. So what India, since India has to pay to Australia, so India will instruct its intermediary bank to pay to another intermediary bank. This will be based out in US, since they have to pay US dollars 100. Okay. So the paying currency is US dollar 100. India has to pay to Australia USD $100. So India will instruct its intermediary bank to pay $100 to such and such bank. What this bank will do, it will again get in touch with another intermediary bank in US, and it will say that, okay, you move $100 from this account to this account. So that will happen, and then this intermediary bank will send an intimation to this in Australia, and then finally the Australia party will get a confirmation that the $100 has been credited in your account. Okay, this is the chain. This is through generally called as Swift. Okay, this is how the transaction happens. Now, in between this, there will be charges by this, charges by this, and charges by this party also, and it will involve time, right? So, if you see, this kind of transaction involved multiple parties and involved some chain of events. The first chain of events is India intimating to intermediary bank in India. This is, let's say, I. Then I informing to U, which is intermediary bank in US. Then U informing to A, which is intermediary bank in Australia. Then A informing to Australian party. Okay. So in a way, if you see, this is a chain event. This is a chain event. Now, is there another way so that instead of this, India can pay to Australia and we can eliminate all this, but we can record it properly? So what happens? Both India and this party will have to come to a common platform, first of all. Okay. So there is one common platform on which they will come. Now, in that common platform, whenever that payment is done or whenever any activity happens, so there will be a block that will get created. What is a block? Block is something that stores information, right? It will store information of what exactly that India is paying $100 to Australia. This will be in a coded form, right? I am just putting it in a way that it is understood by all of us. So India is paying $100 to Australia. After this, India will have a balance of $1,000 and Australia will have a balance of $1,100. And there will be a unique number attached to this block. So what has happened? This block is created by a decentralized mechanism and it is open to be viewed for both India and Australia and even to others who are on this platform, right? As I told you, there is some common platform. So whosoever is on this common platform, they can see what is happening. And this is actually the data is entered and stored in an encrypted manner. So that there is no changes. So one is decentralized, second open to be viewed for both India and Australia and anyone on platform. Third is it is put it in an encrypted manner so that it cannot be changed later on. So today this is entered. Now what? After 10 days, it is changed. It is not allowing you to change. Even if you have to change, then again, a new block will be created. So this is one block for one transaction. Now, similarly, whosoever people are there on this common platform, there will be multiple blocks created. Let's say this is block 1. This is block 2. So similarly, like India to Australia, now Australia also needs to pay to, let's say, New Zealand. So that will be block 2. This will be block 3, right? And all these blocks are connected through a chain. So these are sequential blocks. Now there will be thousands and lakhs of blocks that will keep on getting created on a daily basis because of the number of transactions. and all of them will have a interconnection. Interconnection how? So block 2 will also store the previous block details as a unique reference. So let's say this has a unique reference of it will have a very big, coding kind of a number 1, 2, 3, 3, 4, 5, ABC, like that, right? Using a multiple combinations. So this block's unique number is also kept here. This block's unique number is also kept here. This block's unique number is also kept here. So so that if anyone is at block 4, he or she can go to block 3 and see what was the data. Similarly, if anyone is at block 3, he or she can go to block 2 and check what was the data. Right? So that there is a proper linkage. And no one can edit these blocks later on. I hope I'm clear till now, students. So this concept of putting the blocks as per the information and putting a chain around it is called as a block chain. Okay, this is called as a block chain. Now, I would want all of you to replace dollars here to Bitcoin, correct? Because there is a common currency that has to be traded. So there are a lot of common currencies. One of them is Bitcoin. Okay. The the biggest advantage here is that the authenticity of data and the seamless flow of information, because you can imagine that there is decentralized database which is edited by multiple person on platform at one go. Okay. So Tanisha, yes, there is a way to sequence it. The number is sequenced in a particular numbering. Okay. Then only it is attached to the next block. Okay, students. So so the steps also, how it happens. Someone will do the data entry in this. Okay. Let me just go to the process. So first of all, blockchain is mostly used in the financial parlance to send and receive money. I will tell you the other uses also, which is the non-financial use. Now, sorry, the step one in this kind of a transaction will be like sending money is initiated. That means data entry to block is initiated. Correct. That is the first step. Someone will initiate the data entry to block. See, students, please appreciate that nothing is moving physically from one place to another. Okay. Not even currency, not even any other thing. It's only the data entry that is enabling. It's kind of an electronic ledger that is visible to all. So data entry to block is initiated. Okay. Then second step. Then this transaction or this block is broadcasted on the network, because as I told you that there is a common platform. On that common platform, this block is then broadcasted. Then the network, there are some people on network who will validate. Network will validate such blocks, right? Using cryptography. And finally, it will be admitted to the chain as another block. represented online as a block, and then it is added to the existing chain of blocks. And finally, the transaction is complete. So students, these are the steps for the for creating the blockchain. Now, Mancha is saying privacy is compromised. Yes, you will come on this platform once you know that that relevant data will be published to all. Okay. It is a fully digital ledger. And what are the chances for hacking? Okay. Like if I can show some Bitcoin in ledger under my name. Yes. So Anumula, see, first of all, yes, it is a digital ledger. It's a online digital ledger which has complete and 100% encryption. That is what it is claimed by the network owners. Okay. Because there is a public key and private key in this. The way they actually use the encryption is through a public key and private key. Like we also do it for our digital signatures, right? There is a public key and private key. Okay. But let's not go into that. We have a very basic understanding to be used. Now let us come to what all places blockchains is used. Applications of blockchains. See, first of all, in financial services, we have discussed. Correct. In financial services, to make the payments, blockchains are used. Then healthcare. So if you see, sometimes doctors have to keep the entire history, medical history of the patients, right? And it is kept in the form of a chain, right? First this test, then second this test, then third this diagnosis, then fourth this test, then fifth this diagnosis. So this is also following a chain of events, right? So even that also can be put in the blockchain. So that data can be entered in one of the blockchain and the blocks will be formed. It will be preserved. It will not be changed. It can be kept in an encrypted form, which will be only be visible to those who are there on that platform. Then government also has to keep a lot of records, right? Wherein, let's say the voting related records, right? Land registration, that is very, very important. What happens? Land is one, right? But owners keeps on changing. First this owner, second this owner, third this owner. Then sometimes it gets splits. Sometimes after splitting, it gets consolidated, right? One land gets split into four parts. Then out of that four, next time, three of them sell it to one owner. So now it has become three and one, like that. So entire chain events of those land registrations can be kept in blockchain. No, no, we are not saying, Tanisha, that the authenticity of data there is a concern. No, because as I'm telling you, that someone will review these blocks and then only it will get added. Okay, here. So data will be authentic and encrypted, right? And privacy also, there is no issue as such because you are there already on the platform. Then only your data will be visible, right? So let's say this, you would want this to be visible to everyone so that everyone knows you have still $1,000 and Australia has $1,100. So both of them will still want this to be visible to everyone. Then only they can claim, right, that this belongs to them. And in next block, if India has to perform $900, it will prove through this block that I already have $1,000. Okay, it's not about like privacy will get this thing. And even in the healthcare, I'm telling the medical records will be kept in an encrypted manner. It will not be accessible to anyone outside that. which is only doctors. Okay. So government is clear. Then we have travel industry. So travel industry also, wherever we have lot of information flow. For example, for applying visa, there are lot of passport and related supporting documents, right? That goes. So all those can be built into the and stored into the blockchain things, right? And then economic forecasts, right? Because in economic forecast also lot of, again, the sequential crunching of events happens, which can be used under the blockchain technology to store it and do that linkages from the different blocks. Everyone means only parties to the transaction or third party? No, not third party, only parties to the transaction, plus the parties who are there on this common network, on this common platform. Okay. So there are different platforms for, let's say, blockchain, right? There will not be one platform. There will be different platforms. Okay, perfect. Now let's come to tokenize. I hope blockchain is clear now, students. But there are certain risks also that we said, right? Now, tokenization process of converting tangible and intangible assets into blockchain tokens. So what happens? Let's say, what do we mean by tokenization? See, Tanisha, bank don't need, see, bank can use, but as of now, bank have their own, internal systems to record the transactions, right? Hence, they will rely on that more. But if they want to enter any kind of transaction wherein the economic ecosystem is changing, then they might use it. Okay. Now, tokenization is basically changing the physical form into some kind of blockchain tokens and even some kind of intangible assets also. Now, let me take an example of a good artwork. Let's say a painter has painted a very good painting, right? And that painting can be sold in a physical form, right? However, what that painter can do along with the help of these owners, the that can be converted into a blockchain token, and then that blockchain token can be added to the chain of such artworks, and hence it can be priced in that market and accordingly sold. Okay. And that blockchain token itself will capture the information of seller, buyer, what price, what is the specification, all those things will be captured there. So what will happen then once that blockchain token is created, that even can be sold further. Let's say that token is purchased by me in the blockchain, then I will sell it further. So it becomes marketable for the same underlying of that painting. Now that token can be traded in the market. Hence, it is related to securitization. Although we are not saying securitization and this is same, but the features are almost same. What are they? One is liquidity. Will it enhance your liquidity? Yes. Both in case of tokenization and securitization, the liquidity will be enhanced. Correct. Because securitization itself is the process of converting illiquid assets into the marketable securities. So the illiquid assets will get converted into marketable securities. When they will be sold, they can be purchased or sold in the secondary market. Similarly, tokenization is converting those piece of works which are tangible and intangible into nature into a blockchain tokens which can be traded later on. Second is diversification. So, as I said that in the portfolio discussion, diversification means that you are diversifying or you are attracting different, sorry, you are diversifying means that you are investing in the different stocks. With this, it also leads to diversification, right? Because, I mean, we have taken an example of painting, but maybe you can take an example of any other thing which has a risk associated with that. So that risk can be mitigated because now you have a easy hand to purchase something else through these tokens, and hence that diversification can be possible. Yes, Anumala, you are right. Trading trading is very much possible because a lot of people are involved in this. So a person needs to sell, they can sell. A person needs to purchase, can purchase. Again, they need to be on the same platform, doing that block and then attaching it forward. And it actually provides new opportunities to both the network provider, the people who are on that network. There are people called data miners. So if you go in deep, you will have a lot of things to understand, but we have very basic things to cover. So what happens, students? There are some set of people who are called as data miners. What will these data miners do? They will evaluate this block. They will authenticate this block. They will actually do a mathematical procedure on this block to solve for the authentication, and then they will add it to the network as a chained block. These people are called as data miners, and they are also getting let's say evolved in this entire process, and hence the new opportunities is also there. Okay, Tanisha is saying we studied in C Inter about data miners. Perfect. Instead of painting it, it is a physical cash loan. Yes, Anumala, you are right. So in securitization, let's say you have to securitize a painting. SPV purchases that painting, and SPV is actually, issuing securities for that, marketable securities, so that lot of people can enter for that purposes. So, I mean, it's very much relatable, but again, the question will be what will be the cash flows out of that painting? Correct. So, hence, blockchain gives you a higher flexibility. The tokenization piece can be covered accordingly. It will give you a higher visibility to higher, practical ability to do the changes. So, students, with this, it brings us towards the end of the entire, topic. I hope you are able to understand and you are able to clarify your doubts. If there's something is left, please do let us know. So securitization is all about creating the SPVs, the creating the securities in the monetized format, and
Okay.
hence taking this process up. CA Ashish sir is also there with us. I would request sir to please help with the concluding remarks. Sir, over to
Uh,
you. Thank you.
Thank you, Devas. Thanks a lot. Your session was very encouraging. In fact, you have made this numeric theoretical topic so much interesting that students are very interactive during the oral session. So, because especially blockchain, it was also enhancement for my knowledge too. Student, Devas sir had discussed the concept of Bitcoin little bit, but please remember that as ICAI, we never, from the ICAI, we never encourage to trade in the Bitcoin. It is our disclaimer. Okay. Of course, Bitcoin appears to be very fancy one, but my request to you, we don't indulge yourself to into Bitcoin trading. Of course, you should understand the relevance of the same because if we see their importance in maintaining the records, actually it was started as a maintenance for the record. The purpose was to maintain the records, to control the records. It is kind of a distributed ledger system. So, but later on, it has become some like what kind of a speculation type of a thing. So, I hope student with this, the topic of securitization must be very much clear to you. And of course, this topic is theoretical, but even if any practical comes, it will be very little bit very simple. But you can easily solve at your own. So you should understand the concept. So now with this, we come to this topic and securitization. Now we shall start in the next class. We shall start our new topic. Divas sir, thanks a lot for sparing your precious time. And as a customary, just write down our phone
Sure,
number
sir. Sure, sir.
0120 3045 956. Okay. Thank you, student, for your patience listening and have a nice time. Okay, sir. Divas sir,
Thank you,
thank
sir.
you.
Thanks a lot, sir. Thank you. Thank you, sir. हाँ जी, सेशन ओवर अशोक जी.